Hello and a very warm welcome to my Q2 2024 market update and outlook for the remainder of the year. Thank you so much for tuning in. This is always a great opportunity to connect. We're 50% of the way through 2024 calendar year, so it's a great time to assess where your finances were at the beginning of the year, how far you've come, any changes we need to make, and of course, if the Australian financial year is relevant to you, to have a look at your strategy, obviously down in Australia as well, when it comes to super, tax planning, property, or anything else that may be relevant. But back to what's happening in the markets. We have seen a bit of a volatile second quarter, particularly in the month of June, largely driven by a bit of uncertainty around when the Federal Reserve in the US would be cutting rates, which obviously we are all very focused on in terms of timing. And of course, AI being the market darling as a sector at the moment. We saw a bit of a sell-off with Nvidia, which probably got far more media attention than it really deserved. A bit of profit taking, obviously a bit of a downtick in the share price, but still very, very strong growth that we've seen since the AI space has really taken off. Broadly speaking, we are expecting to see positive economic growth throughout 2024-25 and then 26-27 as well. Of the G7, so developed economies around the world, most analysts and economists are expecting economic growth of about 1.6%, followed by 1.7% in 25-26. So no forecasts of any sort of meaningful recession or depression, but just slower economic growth, which is expected, particularly given we are in a high rate or rate tightening environment, very much designed to cool inflation, which obviously cools economic growth as a result. And that will remain until inflation is well and truly under control. So plenty to touch on in this video. We're going to have a bit of a look at what's happening around the world, what's happening in Australia in terms of tax rates, the Aussie dollar, superannuation changes, and of course a few general updates and things for you to check out. So let's dive into what's happening in the United States. Now, looking at the US market, we have seen strong growth, both the NASDAQ and the S&P 500 as the major indices that most investors are watching. The S&P 500 up about 15-16% in the first half of 2024 calendar year. But it's important to note that about 59 to 60%, so just shy of 2/3 of this uplift, has been driven by the Magnificent Seven. Now, you may know them as the FANG stocks, the tech giants, the tech market darlings, the big tech names that you will know, Alphabet, Amazon, Apple, Meta, Nvidia, etc. These are the ones that are doing the majority of the heavy lifting. They were sold off aggressively in 2022, and then thanks to the very, very strong uplift in AI, and obviously the rebound in a number of these tech giants, that has led to obviously some very strong growth through 2023 and then the first half of calendar year 2024. So it is important to note, because when you look at your portfolio and the actual overlap of your holdings or the level of diversification, you may have a lot more exposure to these tech giants than you otherwise realize. I spoke with a client just recently, a new client who came in and we went through a portfolio review, felt that he was very well diversified, a group of different ETFs listed around the world. There was some S&P 500, there was some NASDAQ, there was some information technology, and then there was basically some quality growth companies. The majority of the portfolio sat in those top 7 companies. So absolutely no diversification. So it's a great time to be reviewing what your actual diversification looks like as we head into the second half of 2024. Now, outside of the tech giants, obviously all eyes on the Federal Reserve for when we may get a rate cut in the United States. Original expectations were that we may get a cut as early as March in 2024. That time has obviously come and gone. Then it was May, and now most are sort of expecting that we'll get a rate cut in November post the US election. Now, of course, that could very easily spread or be kicked forward into Q1 of 2025. But of course, the likely direction is for a rate cut and for that trend to continue. Now, what will that lead to? Well, in all likelihood, quality growth assets, particularly those undervalued growth assets. So for us, we quite like the small cap space at the moment, representing quite good value. we believe there will be quite a bit of upside on the back of rate cuts in that space going forward. So some good opportunities to position ourselves before we head into that rate cutting cycle. When it will begin, I think, is very much anyone's guess. Given current inflation levels, I can't see it within this third quarter or between July and the end of September. But of course, it would be a bit of a blessing if we did get that cut faster than expected. And then obviously the central banks could continue on that trend, followed by mortgage costs obviously coming down on the back of that as well. Now, obviously in the US, we also have the election coming up. We just had the presidential debate, which provided all of the entertainment value I think we expected. And I guess we've come to know and love of US election campaign times. The outcome of the election, we're not expecting to have a huge impact on markets. And if you look back at the last 50, 60 years at the different elections, we've always found that a blend between the two parties has often been the most positive for markets. But the reality is that it really has a lasting or meaningful impact in terms of stock market growth. Naturally, one side would be more favorable for business than the other. But of course, time will tell which way that unfolds. We're not expecting to need to shift or rebalance portfolios a great deal on the back of that election outcome. So a bit of an update on what's happening in the US. In terms of sectors, we're very much still bullish on cybersecurity, financials and healthcare, and of course the sort of peripheral AI space and those small cap growth and value stocks with the view that we'll get those rate cuts in the not too distant future. So a bit of an update on what's happening in the US. Let's have a look at what's happening in the Eurozone and the UK. Now, we have started to see a bit of an uptick in economic growth and forecasts for the Eurozone. Obviously, geopolitical tensions remain high, and that, of course, remains a key concern in terms of where we're investing in the Eurozone. So we're very much focused on the blue chip parts of Western Europe, and particularly the large and mega cap stocks in that space. We did see France call a snap election, as you may be aware. So political volatility we expect to remain very high. Obviously, immigration volatility concerns, I think that is really going to occupy a lot of the political landscape going forward. So, I think we need to be cautiously optimistic in that space in terms of how we actually allocate to European equities at the moment. We did obviously get the European Central Bank cut rates just recently. They have hinted that another rate cut will not be on the cards in the not too distant future or in the near future. Now, does that mean there's no more rate cuts in calendar year 2024, but maybe in 2025? That would be our read on the situation. But of course, this will be driven by central bank activity around the world, economic growth, and just how quickly inflation cools. So watch this space. It could very much change quite quickly. So that's a bit of an update on what's happening in the Eurozone. Let's have a look at what's happening a little closer to home in Asian markets. Now, a key focus area in the Asian markets recently has been Japan, not just from a tourism standpoint, given the weak yen, but that has obviously led to quite a strong level of outperformance of Japanese equities recently. We have seen some changes in corporate governance and the rules operating around the Japanese stock exchange. So that has also led to a bit of an uptick in Japanese equities. We do think that the weak yen, if that has bottomed and does stabilize, may present some good opportunities for investors. Certainly not the time to be selling everything else and flooding Japanese stocks, but probably not a bad time to be starting to look at some sensible exposure in that space, particularly mindful of the fact that we may very well get an uplift or an uptick in the yen going forward. The Japanese central bank has really, or Bank of Japan rather, has really shown no signs of looking to ramp up rates anytime soon. But again, we need to be mindful of central bank activity because that can obviously lead to some fairly quick changes in currency strength or weakness going forward. So watch this space. Outside of Japan, if you look at Singapore, Hong Kong, very much as steady as she goes. We continue to see a bit of an outflow of expats in Hong Kong. We do expect that will continue. The sort of general population in both countries are not flooding back into the office just yet. So the sort of commercial or office footprint of most multinationals and companies in these countries is not ramping up quickly, which translates to the fact that we do expect that commercial property is going to remain under a bit of pressure going forward, particularly with rates remaining quite high. So We're not expecting either to really present strong opportunities for investment just yet, but we will be watching this space. Obviously, Singapore government bonds remain quite attractive for those looking for a stable, consistent return. Certainly not going to be shooting the lights out. And one might argue there are better returns in term deposits in Australia, for example. But if you are looking for local exposure, removing that foreign exchange risk, again, there may be some opportunities in that fixed income or bond space going forward. So that's a bit of an update on what's happening on the ground here in Asia. Let's have a look at what's happening down under back in Australia, both in terms of super changes, tax changes, and of course, the broader economic scene. Now, in Australia, we've seen plenty change. We have just entered the new financial year in Australia. For anyone who's unaware, it is 1 July to 30 June. So as we enter the early part or first half of July, obviously we are into the new financial year. So a few things have changed on that front as a result. We have seen the stage 3 tax cuts come into effect, which means that the majority of people in Australia are saving a bit of money, a little less than was originally proposed. But if you are earning above 190,000, then you are going to save about $4,500 each and every year. Now, given that the majority of people will be saving a bit of money as a result, it is a great opportunity before lifestyle creep comes in to start to think about how you put those savings to work. Should you increase your mortgage repayments? Should you bump up your super contributions? Should you be increasing the automated school savings investment that you've got going? Whatever it may be, before lifestyle creep gets in the way, start allocating these savings to a sensible place. It might even be as simple as that money goes straight into your offset account to secure your mortgage on your primary residence. Of course, there is no one size fits all, but take advantage of this as soon as possible. Obviously, time is of the essence. The other big one we have seen are the changes to the superannuation contribution rules. The concessional limit, that is the pre-tax or tax deductible contributions that can go in, have been increased from 27,500 up to 30,000. Now that is good news for both residents and expats. As an expat, if you have taxable Australian property, meaning a property generating positive rental income, or if you sell a property in Australia and there's a taxable gain, this may allow you to get more money into super to offset more of that tax bill. So it may not sound like a huge jump, but it is meaningful enough. The other big change that we have seen, or sort of somewhat meaningful change, is the non-concessional limit has increased from 110,000 to 120,000. Now, this is the after-tax money that can go into super. What this means is that if you're planning to repatriate to Australia, or you're planning to go and retire in Australia, or you're nearing retirement and you're already in Australia, this could be a good opportunity to get more money into superannuation if it makes sense for you. So, of course, seek advice. Contributing to super may or may not be favourable, depending on your goals and situation, but some positive news in terms of those increases as a result of this new financial year. The carry forward concessional contribution, being able to carry forward 5 years at one time, is still in effect, and the bring forward rule for the non-concessional is still in effect as well, allowing you to contribute up to 3 years in one go. So some positive news on that front. Outside of that, obviously immigration, inflation remain front and centre when it comes to Australian news. We have seen inflation remain above the Reserve Bank of Australia's target of 2 to 3%. And the most recent inflation data suggested a current rate of around 4%. Now, personally, I think we all need to recognise that the downward slope of inflation is not going to be a straight line. That is not how life works. So we are going to see these bumps, but the expectation, at least from my view, is that we continue to head closer and closer to that RBA target of 2 to 3%, which hopefully means that we start seeing those rate cuts in Australia in the near future. Now, we do expect that the RBA will cut rates more slowly and later than the Federal Reserve in the US, which may mean that the Australian dollar does start to strengthen. So if you are looking to build up exposure to Australian dollars, or you're sitting on other currencies, now may be an opportune time to start reviewing your options around getting that Australian dollar exposure. So certainly watch this space. From an equity standpoint, outside of the major banks and commodity players, we're quite bullish. particularly healthcare, technology. We think there's some good opportunities in the Australian market going forward, as well as Australian bonds, particularly given where rates are sitting, the strength of Australian government and corporate bonds. We do think there's a bit of value there as well for investors, particularly those looking for a stable and diversified portfolio in that fixed income space. So certainly some good opportunities there, not to be ignored, but it's a bit of an update on what is happening down on the ground in Australia. So look, thank you very much for tuning in to my Q2 2024 market update and outlook for the remainder of this year. As I said, a great opportunity to be checking in, review your finances, consider your plans for the second half of this year. Are we looking to refinance loans, to buy property, to create tax deductions, to rebalance portfolios, to top up portfolios? Whatever it may be, start making plans now. As I said earlier, we're already halfway through this year. So it's a great opportunity to get on top of this because I think before we know it, we'll be considering what our Christmas plans are and booking flights to go back to Australia to celebrate Christmas with the family or wherever it may be. Now, in other news, please do check out our podcast, recently launched. We've got 6 episodes online already. It is at Money Side Up. We're on YouTube, Spotify, Apple Podcasts, all of the major streaming platforms. So do make sure you check it out. If you have suggestions for topics, let us know. We'd love to hear from you. We're always looking to make sure that it's engaging and providing as much value as possible. We're not selling anything at all, nor will we ever be on the podcast. It is purely there to educate, inform, and hopefully provide a bit of entertainment. But if you do have topics in mind, do let us know. We'd love to hear from you. But otherwise, thank you very much for tuning in. I look forward to catching up with you soon. Have a wonderful Q3, and I look forward to speaking with you soon.